Yo, what's up? This is Noble Woods. Welcome to Insider Trading. This is your live market information news. I'm a real trader. I've been trading for over a decade. I put in 20,000 hours. They say you need to be an expert, although I don't like to throw around terms. I teach. I've taught thousands over the last 2014, 7 years since I started actually teaching. I've taught kids, I've taught adults, I teach futures, options. Foreign exchange is all the same thing to me. You give me a chart, I can show you how to make some money. But we're not here today to talk about a specific stock and making money. We just here to talk today to talk about SVB, Silicon Valley Bank. So I don't know where you are or who you are. Let me first let you know that this is interactive. So if you're watching on Facebook or YouTube, you're watching live right now, Monday. What's today's date? Y'all know it's Monday. You're watching today. You can actually interact. You can ask me questions. You can type something in the box, in the comments, and I'll see it. I can respond. So it's pretty cool to be able to do this live in this way. Because you can sit around watching MSNBC, you can watch Bloomberg and all of those great channels to get news and information, but you can't ask questions. You can't actually interact with those people. You can't challenge them. You can't ask for more details. You can't ask, where did you get that from, that stat, that source? You can't really ask for none of that stuff. So we got a lot to cover today. A lot to cover. I actually have 12 points, 12 pieces of information I want to give you. I was thinking about this yesterday. Shout outs to Joe. Joe was like, yo, you need to go live tomorrow and do something. Because people need to break down from at a level you can understand. So I've been watching MSNBC. I was watching Bloomberg earlier. I've been reading a ton of articles just like some of you guys, or maybe some of you guys haven't. And it's my job to synthesize all of that down and try to give you the core components. What matters? What do I need to know? How did this happen? What's happening? Some of you might not even know what's happening. All right, you might not even know what's happening. I keep looking over here because I got my phone over here so I can make sure the streaming is flowing, and then I got my board, so I got all of my notes. So if I look up, welcome to a real live stream. So let's do this. Let's just jump in. Let's dive directly in and keep it really, really simple. A major bank, the second largest bank failure in the nation, happened recently. And it happened really, really fast. It happened with the bank called Silicon Valley Bank. If you've heard of Silicon Valley, it's where all the tech startups are out in California. It's just known for its innovation. It's a very tight-knit community. If you can get in Silicon Valley, if you can build some networks, build connections. So you start talking about venture capital, VC, equity, building equity funds, capital funds, technology. You can't not talk about Silicon Valley. So, like many of you who like many of you, don't specifically track, a lot of information directly about what's happening in Silicon Valley. Yeah, I know about the main companies and kind of some of the, major players, if you will, sure. But the average person, you probably had no idea that there was even a bank called Silicon Valley Bank. They were established in 1983. Specifically what they did, 16th largest commercial bank. They served a very specific niche, however you say it. If you want to get bougie, a specific niche. And that specific niche is technology-backed companies and startups. All right. So about half of their banking services were provided to, they provided banking services to half of the companies that would call themselves startups, tech-focused. And that's huge. That's a very, very strong, from a business perspective, you look at that and you're like, wow, that's amazing. So they were connecting with these VCs. They were, a lot of these tech startups clearly were dumping all of their deposits in this specific bank. And it had its own little ecosystem of people who knew people and all were in the same industry. That makes sense. Doesn't sound like a bad idea. So what the hell happened? I'm gonna just read a little bit of this. Benefited from high tech sector explosive growth in the last few years. And I'll show you a chart as always. I'm gonna show you the S&P. I want to show you the S&P. Matter of fact, I might go to XLR or XLK. I forget which one of the ETFs is the tech one, but I'll pull it up and show you. I want to show you what happened to tech. Price is going higher, and then where we are today, right? So as always, if you know me, I've been doing these for a while. And I don't do them consistently every week, and I will get consistent. I actually am getting I'll have a specific date that I'll be doing this, and I'll roll out a lot of marketing. You'll start to see this and some ads. You got a whole thing. I got a lot coming. And so, me, I always go back in this period. I want to always keep people I want to keep you up to date to where we are. So I always tend to go back to March of 2020. That's when a lot of people, some of you guys watching, there's a good chance you probably just really got interested in the market and what's happening. And you wanted to learn about trading and options and futures and foreign exchange and crypto because the pandemic had you sitting at home and you had some time. And you knew a lot of people were making money too, right? So hopefully you've been making money. I don't know if you have. Hopefully you have. For my folks who are the super loyal people who always watch and check me out, I appreciate y'all. You know I do. So let's get back into SVB. So explosive growth over the last few years with tech. And then we made the highs, which I'll show you in just a second, in 2021, but 2022 was a bad year. Tech companies have been getting beat up really badly. A lot of layoffs. Amazon, Microsoft. If I show you some of those COVID stocks that everybody just loved and thought we're going to do so amazing, tech specific focused, a lot of them have come right back down to where they were price wise, where the stock was before COVID. So we made a lot of money. The market had an amazing run up. And they won't say we're in a recession. I don't know why, but okay, cool. We're not in a recession yet, although we have had the 2 bad quarters of GDP. But we know we've had inflation. All right, so and here's where we go. Here's where it gets a little tricky. I'm gonna keep it simple. Why did it collapse? It came down suddenly in 48 hours. 48 hours, they had over $200 billion in deposits. I used to work in Bank of America. All right, so I don't consider myself a banking guy, but I technically should. My MBA is in marketing. My background is in marketing. I've worked in marketing advertising agencies before I got the MBA, and then I went into this really dope MBA leadership program at Bank of America. They only have, as a bank, they have less than 24 branches. I was in a market, Northwest Atlanta market, helping to manage on a very small team of people, helping to manage consumer marketing. Helping to manage about 37 branches, right? So Bank of America, big, huge bank, one of the 3 big ones, right? So this is the 16th largest commercial bank, focusing heavily on businesses, commercial, right? So to give you some context. And I can't lie, y'all, right now, what I'm seeing with the charts, what I'm about to show you today, what I'm gonna show you with the VIX, and join me tomorrow, I'll be able to go through your specific stocks. I wanna go through the stocks you wanna look at tomorrow. I just don't have time to do it today. I wanna stay focused on SVB and give you a lot of information around SVB. But this is eerily reminding me of when I started at Bank of America. And I'll never forget this day. Friend of mine at the time from grad school, he hit me up. He said, no, I think Citi's about to get a bank bailout. I think the government is about to bail them out. And I was like, And he knew more than me at the time about, options and just how all this worked. I was really just cementing my foot, getting, into this, becoming a trader. This was 2008. And, I was in my apartment in Charlotte. They were paying for my corporate housing. I took $5,000 out of my savings and I just literally dumped it all in y'all remember Share Builder? I purchased as much as I could through Share Builder, $5,000 worth. And then what happened? About 20 minutes later, went across the news. CNN just announced Citibank receiving a $58 billion bailout. And I was like, oh snap, I'm about to make some money. And I did. That 5K, it doubled in, I don't even remember the time frame, but I didn't do anything. I pushed a button based on somebody else's information who knew more than me at the time, and I waited and I magically had more money. And that's when this this investing thing really clicked for me. That knowledge, applied knowledge, can make you some money, can make you some power. Now I was making 6 figures, cool. But we started and we fell into a recession, and other banks started to fail, and smaller banks started to fail, and regional banks had solvency issues, which we'll talk about in a second. So as soon as I saw this, market was down last Thursday and Friday, all this stuff started moving, and people started talking. I'm doing some research over the weekend. I'm like, oh, this reminds me of the recession of '08. So is this a catalyst? Is this the first of many? Is this just the beginning? Should you get ready to short the hell out of everything and be in put city? Maybe. So on that note, y'all know I wear the cap to tell you how I'm feeling, and I wanted to change my cap real quick from the Bulls to the Bears, because I'm a bull at heart. If you're a long-term investor, which you should be, you have to be. If you get some more advanced skills, you can make money when the bad happens. You can make a lot of money when things get volatile, when things go down. If you've never heard of the term shorting a stock, it's essentially, to keep it simple, it's making money when the stock comes down. If I had time to explain it fully, I would. I don't right now, but one day. Join one of my classes. I break this all down in my class. So once again, why did it collapse? Because of a crazy 48 hours. And because of what happened preceding that. The root goes back to, like other banks, SVB plowed billions into U.S. government bonds during the era of near zero interest rates. Near zero interest rates. What does that mean? We talking about treasury bonds? I know some of y'all like, man, I ain't get a B. I don't have an MBA. We start talking about treasury notes and all this stuff, it starts to lose me. All right. So let's keep it simple. Municipalities, cities, the country, you can buy savings bonds. You can invest in savings bonds. They're really safe. Why? Because they're backed by the government, all right? Or this backed by the city or backed by a company. So there's different types of bonds. But the treasury bonds, we're talking about the federal, like we're talking about the government. We start talking about treasury, anything. All right, and so they did what, folks, you probably have a grandmother, you got somebody in your family who they told you about buying some bonds. They had some bonds, right? I actually had a friend. This is crazy. I had a friend who her father bought some for my parents watching. Check this out. For my parents watching, I got a friend who, her dad bought her a brand new vehicle when she got to college, or maybe like after college. I can't remember. Her car had got messed up. She got in a little accident. He bought her a brand new paid cash for it because he cashed out some bonds that he had bought decades, long time ago. He put some money into bonds. They're very safe because they're backed by the government. And if you wait, usually it's a pretty good rate. But here's the thing. What you're paid by those bonds, it's impacted by interest rates. So, interest rates. We're in a place right now where everything is higher. Homes are more expensive. Everything's more expensive. Why? Because the government printed all of this money, printed a lot of cash, surplus of cash. Why? From stimulus checks going out. Market is shooting up. Market went higher. And the market has a way of balancing itself out. All that money we printed, you just paying it all back. You just giving it back if you got a check, you just giving it back to the government when inflation hits. All right, from the printing and surplus of all that money, everything becomes higher. I'm charging more, gas is higher, every company's charging more. You just follow suit as a business owner. You just follow suit. Inflation happens. It happens. But when it happens with a bank that had billions invested, what seemed like a safe bet quickly came unstuck as the federal hiked interest rates aggressively to tame inflation. All right, so keep this simple. The government is trying to tame inflation. All right, All right, so it's hiking interest rates. All right. When interest rates rise, bond prices fall. And this was one of those banks that was literally taking mostly all of the money that they were getting as deposits. And you got to think about how a bank works. Like, how does a bank make money? They take your money, my money, our deposits. All right. They grow that money in bonds and other types of securities. They take our money, our deposits, fractional reserve. They grow it. They got to keep a certain amount of cash on the books, but they grow that money and then they loan it back to us. They take our money, grow it, And then they give us the opportunity to get home loans and mortgage loans, home loans, auto loans and personal loans, and we pay those back. And some of y'all pay that stuff back with or make banks rich because of punitive fees, overdraft fees. I don't even know if I should say this. I guess I should. I remember when I was at Bank of America. I'll never forget this. This was during the recession in 2008. I worked on a checking operations team in Charlotte at the corporate headquarters. I was making six figures. So don't get me wrong. I'm not trying to make it seem like I was up there making big decisions. I really wasn't. But I was in the room listening, right? I was in the room listening, taking notes. I was a newbie, right? And we had this meeting one time, and they were talking about overdrafts. We had made $5 billion. I'm sorry, Bank of America had made $5 billion in overdrafts, punitive fees. And the idea was they were talking about adding some other little fee to encourage you to go ahead and get your account card up so you don't get another fee. So I was like, wait a minute, y'all gonna give people struggling a fee when they already have fees that they can't pay, so they'll stop getting fees. I was like, wow, I can run a bank. If that's how we doing it, I can run a bank. And then we have the ethical question. How did we get here? We always get here the same way. Capitalism it's interesting. It's interesting. I'm African American. I overdosed this last February. To be real with y'all, I've been studying so much history, American history. I don't even call it Black history. American history. What happened to this country? When you really study how capitalism, why it flourished, it's so interesting. So interesting. And yes, we're the most powerful economic country in the world, and I appreciate the laws and freedoms and privileges that I have. But when you do the history of America and you really get into capitalism, there's corruption there. It's just the heart of man. There's always going to be some corruption. So how did this happen? Not necessarily from corruption, but from bad decisions. I really would say from bad decisions and too much risk. And I'll explain that a little bit more too. Let me see. Am I finished with this page? Interest rates are let me see. Interest rates. Oh, y'all can't even see this. I like showing you so you can read along. It's like almost having captions. Just a different way of having captions, right? When interest rates rise, bond prices fall. So they had billions of dollars in bonds that they bought in like 2021, and those were pretty much not making them any money. Now they could have went with some shorter term securities. They went with long term securities. Longer term bonds. They could have went with shorter term securities, but they really wouldn't have stood to make what they wanted to make, because you got to actually generate some money from taking these deposits and putting them in securities that can actually grow this money so you can loan it back, blah, 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 right? Cool. But they didn't do that. And that was a choice, and that changed the risk profile of this type of decision, right? Changed the risk profile of the decision. Was riskier, because the question should have simply been, well, what if the market, it's up, it's 2001, they're buying all these bonds, it's just flooding money buying all these bonds. But what if somebody in leadership had to say is, the market has just shot up for 2 years. We've had two of the strongest years we've had in a long time, and we printed a lot of money. Is the inherent risk, if we get 1 or 2 bad years, especially if the tech sector gets hit bad, how will that affect? They're probably going to raise interest rates. It's probably going to lower our bonds. We're not going to be making any money. We're going to have to start selling furniture. We're going to have to start selling assets just to cover, so our clients can actually have access to their cash. Because we took a lot of their cash and put it in these bonds that aren't even making us any money. So that's back to decision making. It's back to decision making. Every investment is a decision. A lot of you guys follow, it's crazy, man. You follow these traders and people who all they talk about is money and numbers and what you can make, and it just woos people. If you don't meet a serious trader and they're not talking about risk, you're being scammed, you're being finessed by master manipulators. And it's so prevalent. I'm not thinking about anybody specifically. I'm just talking about the industry as a whole. For you guys who are watching, who are like, you getting into trading, or you're looking for people for, you're watching this as content, right? I always talk about the risk. Always. And most people lose money, and when it comes to like the market, because they're afraid to lose money. That's usually why you lose money. because you're so afraid of losing. You haven't accepted that losses happen, and you're over leveraging. All right. So in the same way that some people approach the market and making these decisions the wrong way, you run to the traders, anybody who looks like they making crazy money, and they never talk about the risk or the losses, or they act like they never lose. They're scamming you. I guarantee you they're scamming you. It just hasn't come out yet. So businesses, people running these major corporations, they make bad decisions too. They take on too much risk. They do. It happens. It happens. Regulators can come in and make a million rules, but those rules don't necessarily force a decision. There's still leaders who have the freedom to make good and bad decisions. So, let me see. So what actually happened is there was a run on the bank. What the heck is a run on the bank? Let me jump over to this slide for a second. I like to show y'all this so y'all can learn to look it up yourself. All right, keep it real simple. I know all of this, but I just wanted to show you, right? So here's the thing. When a bank run, when you hear the term, there's a run on the bank. What the heck does that mean? A run on the bank. Large number of customers come in saying, yo, I want my money. I want my money. I heard some bad stuff. I've heard bad things. And think about this VC community. The venture capitalists, they know each other. They know all the startups in their portfolio that they have funded and loaned and given this, money to make them money back. And what I'm hearing is a lot of these VC guys and gals were hearing about this, and they went in to protect their money, started withdrawing their money, and they didn't tell some of their own startups in their own portfolio. Shady. Ooh, it's a dirty game. It's a dirty game, man. It's a dirty game. Small industry, small, network of people. So imagine whatever your profession is. I'm a trader. I got friends who trade. If something amazing happens with trading, like, I don't know, Thinkorswim brings down the margin rates on futures contracts, it cuts it in half, like, for everything. Oh, that'd be so great. I'd be so happy. I wouldn't trade and put more leverage on. I wouldn't buy more contracts. It would just be nice to know that they're cheaper, right? But somebody who knows me, who knows I trade, who also trades, would call me and tell me as soon as they know. And that's what happened here. So as more people in that community started to hear about it, they started withdrawing their money. Right? And that creates a solvency issue. Solvency. What the heck is solvency? Real simple solvency. Look at that. The ability of a company to meet its long-term debts and financial obligations. Long-term bonds. They bought long-term bonds, treasury bonds backed by the government at the worst time possible. Right when we go into an inflationary period, potentially a recession, and things get tough. I hate to do this, but I kind of have to. I don't have a real bias per se against Kramer. I've listened to him. I get it. He's one of the popular. He probably cracked the door for like education, entertainment based education shows. Kramer, if you ever see this, I thank you for that. You were the first person I ever saw that I was like, wow, this dude is like having fun. Like, and I'm like that, right? I get excited when I talk about this stuff. But even Kramer a month ago was urging investors to buy Silicon Valley Bank. He said it was still cheap and that it had room to run, but he didn't know about their debt. And why didn't he know? Did he like pull up their balance sheet and dig into it? So I want to say this to you. If you're thinking like, okay, this is kind of scary. Noble, you told me that, this reminds you when right before as banks started to fail during the recession. And this stuff sounds really complex. I appreciate the definitions and you trying to keep it simple. I appreciate all that. So what are you saying? What should I be doing? What should I be buying or selling? Like, what should I be? Here's the tricky part. I'm gonna be so real with y'all. People like me do you guys a bad service by making investing seem simple. And it can be simple in the sense of the process, right? You pick a small amount of companies that you trust, that you know, that you use. You invest in those consistently every month. During the bad months, during the good months. That sounds real simple. It's like, oh yeah, that's investing. And it is. But what nobody tells you is picking stocks. There are thousands of stocks, thousands of exchange traded funds, ETFs, which are just baskets, little collections of stocks. It's like a final, you know, people like right now, everybody with like March Madness is coming up. But with basketball, football, you know, you have your fantasy team. You pick all these players. That's what a fantasy team is. You're picking all these players, trying to see if you can pick, select, invest the best players that'll give you the best return, that'll beat all your other buddies who are playing in these fantasy leagues. It's basically the same thing with investing. There's thousands of options. The Dow Jones, it's a team of stocks. It's an all-star team of stocks, 30 already selected for you. The S&P is 502 of the world's greatest companies already selected for you. It is diversity. It's diversification packaged for you. NASDAQ is probably the last 50 years, one of the newer ETFs. It's 102, heavy tech focus. Remember that. But NASDAQ outperforms the Dow, and it outperforms over the last 20 years. It's been basically outperforming everything except for one ETF. It beats 96 over the last 10 years. It beats like 97% of mutual fund fund managers, people like me who went on to some big bank or some private institution and managed funds that you put your money into with whole teams of MBAs as analysts. And, you know, I got a whole team over here and I'm making all these decisions, getting in and out. And the crazy part is, most people you really don't know if you're a good investor. You don't know if you are unless you bought something and consistently invested in it, or maybe put initial down payment of $10,000 and held it for 5 to 10 years. You don't know if you're good at selecting stocks. You don't. And you don't have to be, because the S&P and NASDAQ, they literally are beating everybody's tail over time. But we get into investing and then we want to start picking everything, and it's like, so I've just been I've been a lot more vocal with, I know you want to pick your stocks. I get it. You have that freedom. Cool. But the chances are over the next 10 years, you're not going to be a better stock picker and get yourself better returns than if you would have just invested in the S&P or NASDAQ. That's data-driven facts. Probability. It's probability. If you can beat over the next 10 years, you can beat the S&P, you can beat NASDAQ, you need your own show. I wouldn't even say I can do it. And I probably can, but it's tough. It's tough. So what's my point? Why did I say all that? Because I mentioned Kramer, right? Saying on the show a month ago, a lot of room to go up. Yeah, you got a lot of, anything has room to go up. When it's down, it's like, what does that even mean? And I'm sure he had more context around it, right? I'm sure he had more ideas around it. I'm not going to play this clip right now, but you just got to be careful. And once again, there are people like me who 5 years undergrad, it was just like 4 years of B school and then 2 years in the MBA, and then I actually worked at a bank. So if we started talking about, really digging into a company's balance sheet, what do you even look for? Do you even know? If not, I don't know if it's really safe or smart for you to be out here picking all these different stocks, making making fantasy teams. That's all you're doing, is you making your own Dow Jones, and you're not going to beat the Dow. You've made your own portfolio. You probably have made your own little competitor to NASDAQ that's not going to beat NASDAQ. So why don't you just invest in NASDAQ? But people don't keep it real with y'all. It's easy to hop on a stream and do this and just give people stuff that gets them so excited they think you're a genius. And I'd rather just be honest with you guys and tell you it is incredibly tough. It's backed by statistics. It's not easy to pick the companies that are going to be the best, most dominant companies that'll give you the highest gains 10 years from now. It's not easy. That's not easy because there's thousands to choose from. So why not go with the all-star team? Starting off until you learn more, right? Keep learning, continually learning, and you become a student of this game. You really fall in love with business. You fall in love with analyzing a balance sheet. I don't know how that is what this is. It's business. You're investing in businesses, right? So, okay. So I hit a couple points there. Let's see, where do I want to go? I got you that. But I'll keep that one simple. Yeah. Okay, I'm gonna go to point number 4. I got my list over here. Point number 4. We talked about me. We talked about what the bank is. We talked about how they invested in these shorter term treasuries. They could have, longer term interest rates when they flipped. That's what brings them down. So they had basically a very large unrealized negative. They had unrealized losses. And when people who are in those startups heard about what was happening, it's human psychology, fear hit. They would have been fine if nobody came in to take all their money out. They just have a situation. But the bank wouldn't have failed. FDIC wouldn't have had to come in to actually regulate, close stuff down, halt trading. Done. If there wasn't any fear. But fear comes because of uncertainty. It comes because of the uncertainty of not knowing, what are y'all doing over here? What are y'all doing? Why are you taking... And then here's the crazy part too. I think they said, what is it? I got some notes. $42 billion was withdrawn within like 48-hour period. A very high percentage, like 97 something percent of the funds deposits were uninsured. So let's start talking about FDIC real quick. They make sure that risk is limited, and they try to protect, quote unquote, the little guy. And I know that's weird to say 250,000 is little, but in business terms, that's little. It's not, right? So they want to protect the little businesses, little people. Yeah, right, little people. 250,000. What if you had billions? Because they went from like 9 billion to 200 billion in deposits over a period of years. They quadrupled their deposits because they were so niche. And all the VCs and tech folks, half of those tech startups bank with them. I've been watching companies all day. I heard about a company, I forget the name of the company. They were talking about them. They said, man, we really didn't have, like, once they froze the money and we realized this situation was here, we can't get our money out. Shut down the bank. It's going to take a while to process this and figure, it doesn't just, it takes time now that the bank is shut down. But they still have people who they need to pay cash to, payroll. They don't have access to those funds. So the lady was like, what are you going to do? And he was like, well, our board was really great. They wired us $1 million, so we'll have payroll for next week. So what about the next week? And then the next week, and the next week, and the next week. So what I'm thinking right now is like, man, okay. Is this fear? Is the fear of this going to slowly metastasize out into tech, into banking, into other spaces? Because you can make the simple connections. If these companies, these little small tech firms can't, and then, if they can't pay people, they have to lay off. And we just had some really big layoffs with a lot of the big tech companies. Where are all of those people going to go? And then what's going to be the future of just like the tech sector with this type of thing happening? And we had what just happened with, what is it? Crypto. You know what happened to crypto? What happened to crypto? One major failure, and then it was a ripple, and nobody's talking a ton about crypto right now. So it's tough. It's a lot. What I've read is that the 250,000 would be covered, and then I guess Biden came in, worked with the feds, and said, "Hey, we're going to cover everybody's deposits." That's good and bad. They won't call it a bailout. This is a bailout. It's a bailout. There's inherent risk. There's inherent risk in business. That's why they only cover 250,000. The bank can fail. There can be mismanagement and corruption, and everybody shares it. The bank shares that risk. The shareholder shares that risk. The customer shares that risk. We all share the risk. Nobody really gets protected perfectly. That's why we always do this thing with Wall Street and Main Street. Who was held responsible for the recession of 2008? I don't think I heard about anybody who went to prison for what happened in 2008. Who was held responsible? We just bailed out every company because every big bank, because we had to. You can't let 300,000 millions of people go unemployed. Can't let the banking system collapse. So, normally what will happen is there will be, they'll cover your $250,000 of deposits, 250,000 of deposits. I can hear my mother saying, articulate. 250,000 of deposits. And what I read they were going to do was advance some dividends. I don't even get all heavy into dividends, but dividends. A company has made money, they're profitable, they keep dividend is a little kickback to the shareholder to say, hey, thanks for rocking with us, just giving a little bit of profits back. A lot of banks pay out dividends for shareholders. Some people are 100% dividend investors. What does that mean? You just buy the companies that pay consistently a good dividend because you're not so worried about the prices going up on the stocks. You want the checks that are going to come 20, 30 years later when you have thousands of shares and every single share is paying you quarterly a dividend. You're getting some checks. All right, so dividends are important. Dividends are important. Normally in this situation, they cover the 250. They would advance some portion of dividends, and then the rest, right? There's loss. That should happen. I was seeing some pundits today. Some people saying, yo, this was great. They did the right thing. They did the responsible thing. Other people saying, yeah, this might not be the right thing. This might be setting a bad precedence. Why? Because we're not calling it a bailout. But if the FDIC and the government, every time this happens, we go from 250,000 to no, we got to cover all of it. Who pays for that? Your tax dollars should be building roads and building, things that we all need and benefit from. Services that Americans need. And then we get into the political conversation because Republicans are like less regulation, get out of my business, government, less funding for all these social programs, and Democrats are kind of on the other side of that. But as we can see, regulation is important. It's a conversation to talk about regulation when we have these type of situations. And I wouldn't even start talking about Trump. I was about to do some little research. I'll give y'all a little data dump on what he rolled back as a conservative president who removed a lot of regulations in a lot of different areas. I'm not trying to blame him. I'm not. But all of this stuff is connected. The politics, the policies, the decision makers, the FDIC, the business owners, these small communities. It's all connected. That's why I love the market, because it's all connected. It's beautiful. It's so beautiful. Okay. Oh, and then they also came in and removed the management. All right, so all the people who were managing the bank, they like, yeah, y'all gotta go. I talked about investors and their balance sheet. Diversity. I talked about diversity a little bit here. One of the most important things for you to remember is you do need to be diversified. A lot of big banks that are diversified more widely in who they serve, this really can't happen if one sector kind of goes bad. And then hopefully they're not putting all of their the deposits, heavy percentage of deposits in one or two types of assets. All right, so diversity is important for companies and for regular people. I know a lot of people got hurt investing heavily in the COVID stocks like Zoom and Peloton, which right now are doing nothing and just have lost money rapidly because they really weren't strong companies. If you look at the stock price, if you look at the chart, they weren't really amazing before COVID. It was just a temporary thing. You should have made some money and got out. Those weren't the companies to hold for 10 years, in my opinion. And I think the chart proves that too, right? We talked a little bit about Biden. Oh, Biden. Joe. Man. Joe's interesting. That's all I'm gonna say. Let's see. Fear has induced a ton of this, as you know. And as I segue to fear from the VCs, fear from the startups who saw this, were trying to figure it out over the weekend because they couldn't do anything, and then maybe heard about it on Tuesday, Wednesday, Thursday, right? So a lot of fear, right? Today the market actually was up. Man, yeah, it was up, but we actually down. We're still down. We're still in a bearish market. So I'll hit a lot of charts tomorrow. I want y'all to join me tomorrow. I'm gonna definitely cover a lot of really good charts tomorrow. But I'll go here before we wrap up. I gotta show you this. I gotta show you this real quick. So check this out. Matter of fact, I'll give you guys clean chart. Perfectly clean. This is the month chart. This is SIVB. This is Silicon Valley. All right. So, as always, I always try to show you guys. Put a line in the sand so you can see it clearly. 320 right here. You can see that low. Oh, it might have that line. Actually, no. Let me do that. Let me see. How far up did we go? So this is SVB. This is the bank we're talking about. I've been talking about all day. And from the lows of COVID up to these highs, that's a 513% return. That's why they were able to deposit so much money. And they were just flooding money into long-term treasury bonds when the government had just printed a lot of money and we started to go into a little recessionary, looks like recession, GDP slowing down, gross domestic product, inflation. So where are we now? I mean, clearly the bank is done, but even before we got to last week, let me take this to a week chart. How much had the stock dropped before we got to last week? Before last week, let's see. Before last week, we had fallen from this 763, the low. I'm gonna go all the way to the low. We had dropped 75%. All right, 75%. So when I see those stocks, I feel so sorry for you guys who are investing in them without trusting the security of some of the biggest, best companies. And I get it, right? You do want to invest in the up and comers. And this probably would have sounded like such a smart play when we were in that uptrend. But this is where understanding even just the charts come in. The stock it's been just like a lot of stocks. It's been in a downtrend literally all year. Look at this. Peloton, same triangle. Crazy run up, a ton of value, a ton of purchasing, a ton of value and hype and buying, and a little bit of some of it just being a bit pandemonium level from a pandemic. And then reality sets in, inflation starts, we're slowing down, jobs, unemployment spikes, we're trying to fix it, the government's trying to fix it, companies start laying off to clear out, unfortunately, that's what always happens. It's the same cycle. The same things happen almost every time. That's Peloton. Let's look at Zoom. Triangle of death. Popped up, came right back down, right back to where we were before. All right, so sir, there's a lot of those stocks. Let me go to S&P really quick. So actually, let me take everything off my chart. So this is the S&P. I got an alert right there. I'll take it off right now. So conversely, right? S&P rose about 120%. SVB went up 500%. That tells you something. It cruised it way, way, way better for a 2-year period. Much better. Right? Was outperforming. But this is where the common sense and good management comes in. Right? People have great times and just go overboard. That's essentially they were just riding this tech thing out. They were riding it out. Tech was booming. Tech was cruising. Tech nothing bad. You couldn't even foresee anything bad happening. But the market has proven over the last 100 plus years that everything that goes up will come down. It will. S&P, lowest it's gone since these highs. How low have we gone? We've come down about 30? Yeah, 27%. And I know I said I would hit the charts kind of hard tomorrow. I do want to show you one more thing, but I definitely want you to pay attention to this, and I probably will start here tomorrow. Check this out. This candle right here, that was June of, what was that? June of I can't see, this thing is in the way. That y'all can't see. What was that? June of 22. If I draw a box over that month, from the high to the low, classic range. What do you see? We've been in this range stuck for almost a year. When did I say that started? What, June? Yeah, June to June. We almost in June. Couple more months. That's an entire year. It's almost an entire year of the market trying to go higher, and then we came right back down and made new lows, and then we tried to get back up to 4,200 again, and now we're just so me personally, as a trader, as a technician, as somebody who's put in 20,000 hours of studying charts and the statistical indicators, loving the math and knowing how this stuff works, and being able to once again break it down and teach it to kids and anybody, this to me looks exactly like 2008 before the worst part of 2008. From a technical perspective, from a charting perspective, all the tools, best tools I can use, it looks exactly the same to me. All right, let me go to the VIX really quick. Let me give you some game on the VIX. So the VIX is the volatility index. What does it do? It's actually measuring, let me clear it out first. It's measuring technically 16 and 42, they kind of average it out like 30 days into the future. S&P, specifically S&P options contracts. Future. Am I afraid? Am I buying puts? Am I hedging my positions that I'm in? I've been buying Apple for the last 10 years. I think it's coming down. I want to hedge that money by buying some puts. In case it drops, I'll make money on that. It'll lessen the loss. Hedging. You do that through puts. All right? Because you don't want to go short of Apple. You really don't want to be short of Apple, like in the actual stock. Use options. And then there's a ton of options. There's options and options, right? You got vertical spreads, you got singles you can do, you got directional plays, non-directional plays, iron condors, butterflies, you got all that. We'll talk about options tomorrow. All I want to show y'all is this. This right here, this month, that really high spike, when the VIX spikes, it's induced fear. It's telling you that the market is afraid and something's happening. People are uncertain and volume is spiking up. Volatility is spiking up. All right. And when that happens, that's actually usually the best time to invest. I could go back. Let me show you this really quick. These two large spikes. Y'all see that? Two large spikes. Both of those, the VIX gets up to 80. That'll probably be the best opportunity you'll ever have in your lifetime to get invested in the S&P. Now, I'm not going to say a specific company, but as a broad market, if you go back and cross-reference those spikes up to 80, 65, 70, when the VIX gets up to 80, it's so much fear. It's like the market can only go so low before the fear subsides and we start to find positive things to get back in and start investing again. And we're not going to let the economy collapse, not intentionally, not intentionally. So I can't fully show you because I would have to explain way more than I probably want to right now. But trust me when I say there's a pattern, there's something happening right now that literally, to me, it looks exactly the same as this. I'll show you this one. I'll show you this one. So this was the recession. All right. It's kind of like this. We got stuck in a range during the recession of 08 too. And we tried to go higher a couple times. And then once we crossed that bottom, that was the worst part. So just think about that. Little box range, even though you ain't got to be a super trader to get this. You can be a fifth grader and get this. We got to go higher than it. We got to come out of this box. We got to get higher than this candle or go lower and actually go lower. We can't stay in this range forever. And based on banks failing and interest rates, just when stuff starts getting crazy, it's just, all right, it's potentially, I'm not saying it's a fact, I'm not. But based on my technicals, once again, statistical indicators, math, that helps people like me to make logical decisions based on probability. It looks like we're not in the best place and we're not out of this thing that we're still in. It's not over yet. So. Oh man, y'all couldn't even see that. My bad. I did all of that. You couldn't even see it. Well, okay, so real quick, here's where we are today, range. All right, and what I did was I went back right here. That was the recession. Stuck in a range, trying. Government doing everything they can do. Sometimes you just gotta, we take losses. It's part of the cycle of investing in the market. It is what it is. These things happen, they do. All right, so we came out of that box and then experienced the harshest, steepest worst panic, but technically the best time to be an investor, because look at what happened after we came out of that box. If you would have just stayed faithful, kept buying, look at the next 13 years of bullish activity. All right, so nobody cares about this as long as you made money from 2008 to 2022. That's the long-term game. That's why all of this crazy, like trying to make all these decisions, like relax, y'all doing too much. You need to start looking at these long-term charts and realizing how simple this can be if you're invested in the best portfolio stocks. And I know it's not sexy. People like, what's his name? I can't think of his name. What's the guy's name? He does Money Makeover. You know, he's one of those gurus who helps you with, you know, investing. Well, not really investing, but saving and debt. Dave Ramsey. There we go. He's always talking about, and don't get me wrong, I'm not endorsing everything he says, but I love his debt snowball, a way to help people to get out of debt. And you know, he constantly, you know, talks about being really careful of the market. I think if you learn and you get yourself a great class, community, mentor, blah, 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 you can do really well. Yeah, I'm proof of that. Yeah. And I've taught some amazing people. Hell, I've taught some people who won't even let you know that I taught them and put them on and taught them all they know. Sneaky people, sneaky fake gurus out here. But yeah. Got to trade with caution. You got to invest with caution. You should be learning right now. Hopefully this gave you a lot of gems, and it gave you some things to think about. Join me tomorrow at 5 o'clock, same place here on Facebook Live or on YouTube Live. And if you're, I got to say this, I got to plug the room. Go to Insider Trading. Let me go back. Go here to Facebook. That's the test of what's name. Test my internet speed. It's pretty fast. Wait, I'll just go here. Go to Facebook, and then there you go. Insider Trading. All right, so I put up a little thing there. It's a group me and my cousin Joel Harrison started literally about 10 years ago. Amazing group of people, mostly African American. You know, we invite everybody in. I'm just saying that so you'll know what kind of room you walking in. There's a culture, you know, to us, super cool, laid back people, man. But everybody's in there getting it, learning, trying to learn, making money, maybe losing, struggling, but we try to educate, and we've been doing it for years, way before the pandemic. I started Limitless, which is my baby, my class, long-term investing course, and in 2020 I waited 6 years before I started a trading class, and I teach people now how to trade options and futures. And you won't find a better class with more detail, with quizzes, with somebody who you can talk to and ask questions. You really won't. I've been doing this for 14 years now, and it's been a wild journey, amazing journey. And I can't lie, if we go lower or we go up, I'm ready. I'm ready. I got to talk to y'all tomorrow about some slightly more advanced plays with options that you should know about, because options really is options amazing. I just keep saying that every time I get the chance to talk. Options are so amazing. You really do. If you're over 18, you need to learn how to trade options. You do. I'm sorry. I don't care who you are. I don't care what you do. It's connected. It's so central to the economy and capitalism, and you don't have to be some super day trader. There's trades you can do with options that it doesn't really even matter which direction the market goes or your stock goes. As long as it moves and you give it enough time, you'll make money. Now you can lose, you can always lose, but I'm just giving you like a little insight. Some people don't even know that you can take trades that aren't directional, right? Because everything you learn from day one is follow the trend, trade the trend. It's like, yeah, that's true. That is true. But you also can take the pressure off of being right on the direction if you understand some of the more advanced options that most people don't even teach, because they don't even know, because they don't use them themselves. Anyway, thanks for watching. It's been an amazing time. Oh, last thing real quick. If you want to sign up just for more information, you want to stay connected to me, go to limitlessclass.com. Right here. Yes, I want to watch I got to actually take that down because this workshop is old, but you still can watch it. It's chock full of information, and that way I'll get access to you through your email. And yeah, so thanks for watching. I don't think I had any questions. Did I have any questions to pop up? I don't think I did. questions? I'm sure. Somebody said, hey, I don't know who that is. I can't see your face. But somebody said, hey. I want to see the, I ain't gonna go there. I was about to say, I want to see a whole bunch of exclamation points behind that hey. I want the hey from my guys, or if you're a lady. Either way, we all just family anyway. What's up? Thanks for watching. Continue to watch the market. Come back as I get, figure my life out. It actually gives you guys a consistent date to do this. It'll only get better. It'll be routine. It's coming. I've been, I kind of methodically slowly get into some of these things. I build slow, and then I make stuff really solid. I've done that with my courses. I learned that in corporate America. Build a pilot, start slow. All right. Some of these people, as soon as they make money, they are trying to sell you $5,000, $10,000 classes. And it's like, you don't even know anything yet. You haven't been in this long enough. So, it's weird. It's weird. It's an interesting space. It's like the new drug money because everybody wants to make money. So be careful. Invest safely. If it doesn't make sense, if you can't explain it, don't do it. Relax. The market's not going anywhere. The more you learn, the more you have the potential to make money, but the timing is key. You're not going to learn this overnight. It's going to take you years. It's going to take you years to get fully comfortable. And if you want to make this like lifestyle, it's going to be the probably most beautiful and harshest journey of your life because it's going to test you in ways that you don't even know it's going to test you. Because trading is not easy because it's all about the psychology. The charts and all that, you can learn that pretty quick, honestly. But the human psychology to put yourself at risk every day as a day trader or every couple days as a swing trader, it's not natural to do that. It's kind of against our normal biology as humans. We don't like risk. Fight or flight kicks in. And that fear of losing is what causes all of the bad heuristics, the bad mental decisions that makes people lose. It takes years to master yourself in that way. But you got people like me who will help you if you want to get on the journey. So thanks for watching. Come back. Share this video with somebody that you know and that you love who just needs to learn more. Hopefully this was a really good breakdown for you. And come back. I'm out. I'll play my music before I go though.